Dear clients, I'm Richard, Senior Phillip CFD dealer. After providing leadership for the US equity market autumn sell-off, the small cap Russell 2000 reversed course to forerun the equity rally in recouping the losses, thereby encouraging the large cap benchmarks such as S&P 500 and the Dow Jones Industrial 30 to rise back to within a few percentage points of their all-time high. The key catalyst providing equity participants with the biggest weekly advance since the start of 2013 are better than expected US Q3 earnings due dates and last week's somewhat steady global PMI releases, which eased the recession worries that had apparently engulfed the global economic outlook since the start of September. On the earnings front, a positive tone was set as the Q3 earnings seasons galloped ahead, with estimates rising 5.6% thus far, which beats the 4.5% estimate hurdle right before the season begins, according to FactSet. And on the policy front, market sentiment was given a further boost as policymakers were seen as quick in switching gear from policy divergence to policy coordination mode, which is perceived as an implicit policy support for risk markets. For instance, the ECB is reportedly considering additional stimulus measures, including corporate bond purchases to booster growth in the Eurozone region, while St. Louis Fed President James Bullard even suggested that a pause in the Fed's taper of its money asset purchases might be justified at this week's FOMC meeting should there be a deteriorations in the US economic data. As for cross-market actions, I would like to bring to your attention a massive swing in unison on or around 15th of October. Firstly, VIX, the equity fear gauge as it is commonly known, peaked in mid-October, just as the S&P 500 touched a 6-month low, and it has since dived some 40%, while the US and global equities rebounded strongly. During this same period, in mid-October, the Bloomberg Dollar Spot Index also climbed after a significant retreat from its peak in end September. A dollar rebound that moves in parallel with the US Treasury benchmark 10-year yield rising back up to above 2%, post the flash crash that pushed the yield down to as low as 1.86%, the lowest level since May 2013. In essence, these price swings taken together strongly suggests a U-turn away from early autumn's negative market sentiment, thanks to market participants dialing back bets on the premature Fed's interest rate hike after several Fed members voiced concerns over greater risk to the US economy as a result of fading growth momentum in the Eurozone region. To sum up, cross-market actions are now reflecting signs of macro stabilization, which implies that the worst of the September-October risk-off phase is behind us. Indeed, given markets' impression that policymakers are getting their act together, global uncertainties that had weighed on equity markets in recent weeks, ranging from fear of an Ebola epidemic to crude oil contemplating a bear market to continual geopolitical and/or civil unrest, all seem to have receded to the backstage. All said, this week, markets may be slightly jittery in view of the ECB stress test result implications, as well as a somewhat hawkish bias building up ahead of the 28-29 October FOMC meeting on the back of the most recent US economic data showing an ongoing improvement in jobless claims, inflation, and housing numbers. Nevertheless, amidst renewed investor confidence about the macro environment, coupled with the US earnings season cheers, equity participants may wish to consider adopting a tactical buy-on-dip approach on market pullbacks. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies, using many more benchmarks available with Phillip ETFs. With that, I've come to the end of the presentation. Thank you for watching this week's Market Watch. I am Richard from Phillip CFD. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.